This is Business Weekend with Ross Greenwood.
Hi there and welcome to Business Weekend. I'm Ross Greenwood. It is great to have your company today. Coming up on the program, this week dawns as a major test of the government and the Reserve Bank, with inflation and unemployment pointing to higher interest rates. We speak with Westpac's Chief Economist Lucy Ellis, the former Director Governor for Economics at the Reserve Bank.
You could raise an argument for not raising rates, but the RBA has prepared the ground for this.
The US Federal Reserve has a new chair, but now he has to deal with the pressures of Donald Trump wanting lower interest rates and the tanking US dollar. And this all spells danger for global markets if they get things even a little bit wrong. Ed Boyd spoke with BlackRock strategist for the Asia Pacific, Ben Powell.
I think Australia is something of a bellwether, maybe for something that we're going to see more around the world over the next 3 to 6 months.
And the anti-money laundering agency Austrac is best known for giant penalties it's extracted from Westpac, the Commonwealth Bank and Crown Resorts. Well, last week it started an investigation into the global money transfer business Air Wallex. But now its sights are on small and medium-sized businesses, with new laws set to start from July this year. Plus, we'll try to explain the crazy, the silly record prices for gold and silver. But look, first, let's start with the economy and the possibility the Reserve Bank will this week put Australia at odds with most of the Western world by raising interest rates at a time other nations are still cutting. And it's not just us saying it.
What I suspect we'll see is we'll get the interest rate increase from the Reserve Bank next week. Consumer sentiment is already looking a little soft. I think that will definitely pull that down a little further.
So it is a little bit on the high side, a little bit above RBA expectations. So it has added to the chance that they're going to hike rates next week.
I just think the bank probably needs to adjust rates 25, 50 basis points higher over the next couple of months.
The Treasurer says the inflation is not welcome, but not unexpected. What he rejects is that government spending is causing the inflation.
I know that there'll be a lot of political commentary about government spending. Today's inflation number, which did come in higher than we would like, is a reflection of a recovery in the private sector and private spending, not public spending, and that's really clear.
And there was a lot of political talk.
What we do know is prices are just going to keep rising. And I'm thinking about the average mum and dad who are sending the kids to school, and they know that everything they paid for, it's just getting worse. And this government is refusing to face up to the problem. If the government is not responsible for its own spending, well, who is?
So let's get inside the possible thinking of the Reserve Bank, its monetary policy board when it meets, and also the trajectory of inflation and unemployment in our economy, with the Westpac Chief Economist Lucy Ellis, of course, formerly the Assistant Governor of Economics at the Reserve Bank. Lucy, Happy New Year to you. Thanks so much for your time. Is it now a fait accompli? Does the Reserve Bank really have to now raise interest rates at this meeting this week?
Well, thanks, Ross. It's great to be here, and Happy New Year to you too. Look, you could raise an argument for not raising rates, but the RBA has prepared the ground for this. It's made it quite clear ever since its December meeting that it has been nervous about inflation. The inflation numbers have come out too high for the Reserve Bank's liking, and at the same time we're seeing a stronger labour market than expected and stronger consumer spending. The RBA, given its framework for thinking about the economy, is going to look at this and say, we have a problem and actually we need to be a bit more restrictive than we thought we were.
Is it a trouble for Australia that the rest of the Western world, the developed world, seems to be still in its cutting cycle, yet we're already at a point where we're raising as a result of inflation apparently not yet being under control?
Well, Ross, many of the countries that we normally compare ourselves to are close to or at the end of their cutting cycle. So, we're talking 1 or 2 cuts at most still to come for most of the major economies. And in some cases, they're done. There's, New Zealand is probably done. Europe may, the European Central Bank may have one more to go, but, a lot of the policymakers there think they're done. We're very close to the end of the cycle. The difference in Australia, of course, is that for very sound reasons, the Reserve Bank at the time chose not to go as high because it didn't want the unemployment outcomes that countries like Canada and New Zealand have ended up with. But it meant that in the end you couldn't go down as far, and it's been a question of just how far you could go. I think, to be fair as well, there have just been some additional shocks. We've got quite strong public demand coming from that big swathe of infrastructure spending that's only just rolling off now in Australia, and we're finally seeing the private sector come back as household incomes improve. So it's not that surprising that a country that didn't completely push down on inflation with a much higher unemployment ends up not cutting as far. That's actually as designed.
OK, so it's not as designed, but then nor is inflation suddenly rearing its head again. It was the idea that we could possibly have full employment and low inflation bringing down these rates. So it was seen to be something of an experiment. Could we now look at that experiment and say it didn't work in the way in which maybe the government and indeed the Reserve Bank would have hoped?
Well, I have to declare my bias. I was there at the time. But if you look at where we got to last year, we did have inflation in the band and we did have low unemployment. In fact, what's happened is actually just unemployment's actually come back below what people were expecting. And I don't want to make too much of 1 month's figures, but objectively, if you look at both the labour market, looks no longer to be gradually easing the way it had been through most of 2025. But also the consumer has finally come back. We've had several years where the boot was really on the neck of the Australian consumer, consumption was really weak, and now that incomes have improved, real incomes have improved as inflation has come down and those tax cuts have come through, we're finally seeing a pickup in household spending, and it's actually reasonably solid. So in many ways, I don't think this is a failed experiment. It just says other things can happen and you may need to recalibrate.
OK, so with that calibration, there's one other aspect of Australia's economy, and that is as you see the consumer coming back through, as you see more private investment coming back through, it seems as though we can't grow the economy to its long-term trend without creating inflation and therefore the prospect of higher interest rates. Is that a structural problem that the government needs to address?
Ross, at least part of the inflation that we're seeing is actually driven by policy. It's things like your water bill, which was decided by a government regulator. It's the unwind of electricity rebates, which again were decided by government. It's local government council rates, which have been rising at a much faster rate than had been the case. Postal charges also running at more than 5%. So at least some, but not all, of the higher inflation we're seeing has actually been driven by different layers of government. There does seem to be just a little bit extra inflation in the market sector of the economy. Now, some of it's things like food prices. The global price of coffee has been rising very quickly. But there are just some other bits and pieces that are just saying there's just a little bit more inflation in the economy. Remember, the RBA's preferred trimmed mean measure of inflation was 3.3. It's not actually that far above the target range. The issue is that more recently, the Reserve Bank, following the RBA review, has had its mandate recalibrated to say you've always got to be aiming not just for 2 to 3%, but you've always got to be aiming for 2.5. So they're going to be looking at 3.3. They're going to be looking at those 2 quarters of high inflation, not anywhere near where we were in 2022, but higher than they want, and saying we have to do something about that. It's not a big miss, but we still have to be aiming for 2.5% and exactly 2.5%, and that's what they're doing.
So, OK, so should we cut Jim Chalmers, the Treasurer, some slack this week when he basically said that the Reserve Bank has indicated that the government has started to try and rein in its own spending? Or is really some of that government spending? You've talked about other aspects of government, local government, state government charges, but there's obviously childcare charges. There's the big increases in the costs of the NDIS. Are these also adding to the inflation rates of Australia?
In principle, the more that public demand adds to demand, well, it's demand in the same way that private sector demand is demand. What's actually happened more recently is private demand growth has actually started to slow, but private sector demand growth has finally come back after a period of weakness, and just the balance of those two things has turned out to be stronger than expected. And in fact, I'd point to this week's release of, the latest monthly budget outcome, which is actually showing that year to date, the federal budget is actually running $11 billion lower than what they'd previously expected. We are getting more revenue. There's more tax revenue coming in. That's in many ways a sign that the economy is running a bit hotter than expected. And I think, the other thing we need to think about is, we are seeing that pickup in consumer spending. We are seeing a pickup in business investment, particularly around that, data centres and all of that. And I think just all of those things are adding up to a bit more inflation, government policy is not helping, and in fact, disproportionately, the things that are running above 5% are policy-driven, but they're not the only things. And I think part of what's going on is also there's just a lot of things that used to run at 2% and are now 3%, or used to be falling and are now flat. They're the sort of things that we're seeing. So there's just a little bit more inflation more broadly in the system, and then there are some quite clear outliers, oftentimes driven by government decisions, and not just the federal government. State and local governments have been involved in this as well.
OK, so I've been around long enough to know that generally interest rate rises or falls don't come as lone wolves. They come as a pack. There's either 2 or 3 of them coming. What's your own sense about this? How many rate rises does Australia need to bring that inflation back into the band, sustainably? And it really is one enough?
Well, I think it all depends on where you're starting from. And our view at Westpac Economics is that policy was still a little bit restrictive, maybe not restrictive enough according to what the RBAs are trying to achieve, and given that some other things have started happening, but it was already restrictive. So it depends on where you start. Our current base case is actually is one and done. We think it's possible they do more, depending on how inflation plays out from here. But again, we're not that far from the target. They don't actually have to get it down that much further, and policy was already a little bit restrictive. So it's a different starting point from some of those other historical episodes. The other point I'd mention is, of course, the exchange rates moved quite a lot in the last month. In fact, in the last 10 days, whether it's against the US dollar or against a basket of all currencies, the Aussie dollar's up to 4 or 5%. And the RBA's own modelling would suggest that that would have more of disinflationary impact, or similar to more in disinflationary impact than a couple of rate rises, certainly than one rate rise. So the exchange rate's also helping the RBA right now if that appreciation of the Aussie dollar is sustained, which we believe it will be.
Tell you what, always great to chat to you, Lucy Ellis, the Westpac Chief Economist. Good to get your input today. Many thanks for your time.
Thanks, Ross. Always a pleasure.
Well, the other massive story of this week, of course, is the performance of gold, silver and our Australian dollar, as Lucy Ellis was just saying. They're all related to one thing, that is the US currency, which has weakened markedly since the start of this year, even as the US Federal Reserve kept interest rates on hold this month. It was big news when the gold price broke through $5,000 US an ounce on Monday this week. But just a few days later, it was another 10% higher, another $500 through $5,500. Silver has gone even harder. And the gold fever is real. You won't have to see the 100-metre queues at our city centres this week outside the precious metals dealers. And with these record prices, there's no surprise that it's prompted a rush. So earlier this week, we sent our producer, Carly Chatfield, out to the ABC Bullion Company at Sydney's Martin Place to talk to some of those waiting in the queue.
As long as Trump's in place, the instability, gold will always keep on going up.
Well, I don't trust the banks and I don't trust the government. The banks aren't giving any interest, so...
As of now, what you can see, gold is one of the safest investment because the whole world is going down and no one knows about the future. US is fighting its own thing, Russia, Ukraine, another thing, China meltdown is another thing. So people think that gold is the safest investment, and that's what even I'm doing.
Well, I just think it's a good investment.
So where do you get your money from to buy the gold and silver?
I got $1,000 out of my bank account, and I got Christmas and birthday money.
I'm going to swap some silver for gold, actually. So silver's really high, but it'll go higher, I think. But I think just geopolitically, it's getting pretty dicey out there. So that's why the lineup's here, I think.
I mean, I guess it's just good to have. You know, it's smart investment. So you know, it is what it is. It's just smart. It's a smart choice. Can't go wrong with it.
I mean, traditionally back home, I'm from India, and we do invest a lot in the jewelry, the gold and silver. And we consider this as a hedge against the inflation, and for a rainy day we can save it. And traditionally we have been doing that, and that's what I'm doing right now.
At the start, I just want to have some saving and then to buy something instead of just leave it in the account. But then now I see the gold getting more higher and higher, and then I'm thinking maybe to buy some silver as well.
Well, Vivek Dar is the Commonwealth Bank's lead mining and energy strategist. He joins me now from his base in Singapore. Vivek, always good to chat to you. We chatted to those people in the street. You could see that they were kind of savvy, but they were also cashing in on a boom. What's your own sense on this? Because generally when you see things rise 10% in a week, especially gold, you expect a sort of a reaction downwards at some stage.
Yeah, look, this is very strange times in terms of just how we've seen how parabolic both silver and gold has behaved, particularly since the start of this year. But when we talk about what has structurally changed in this market, there's one thing that comes to my mind, and that's safe haven. That if we looked at when was the real turning point for gold and silver as an investment, particularly for safe haven demand, I think the turning point came back in April 2025, and that was when we saw Trump announce those retaliation tariffs or Liberation Day tariffs. And since then, we have seen gold and silver basically replace your traditional safe haven assets like the US dollar as your top tier safe haven asset of choice. And since then, we have seen this outperformance of precious metals, which we think is likely to continue so long as there's top-down policy from the US which continues to risk this sell America policy. So I think this has still got some more miles to go, and we are forecasting gold to hit about $6,000 an ounce by the fourth quarter of this year.
So 6,000 by the fourth quarter. It's an astonishing run, but you're quite right about the US dollar because it's always been traditionally the global trading currency. It's been a staple, no matter whether you're in Lahore or whether you're in Bangkok. You could always trade with US dollars. The reality is, if the world pivots away from US dollars for global trading, I just wonder what the sense of where the world goes to. I mean, we've got crypto going nuts, you've got silver going nuts, gold. They're all hard things to actually do physical transactions with, though.
Yeah, look, in terms of the de-dollarization, look, the US dollar for trade will always be very strong. And it's not that we're going to see the US dollar the market move away from the US dollar for transactions. I think that's a dominant story, and there's no real replacement for what the US dollar offers. But when it comes to on the edges, what we're seeing, certainly there's a push to increase that holding of gold, and we see it in central banks, but even as insurance. Like if we look at, say, the equity markets in the US, in case there is a bubble that is being fueled here by AI, what insurance can we have? And what precious metals is certainly one avenue. If we have constant attacks on the institutions of the US, like the Fed Reserve, and rates are below what it should be potentially as a risk scenario, then where should you put your money in as the store of value? Once again, it's gold. So it's very hard to see kind of where this trade retreats materially unless we see stabilization in US foreign trade tariff policy, which for now it looks unlikely.
So then take me to the supply side of this, because you watch that closely. Gold miners, of course, are going to be trying to rekindle their existing mines, dig deeper, find acquisitions, do whatever they can to try and take advantage of these prices. What's the supply side response?
Yeah, look, I think for sure that you're going to see the economics of deposits become more attractive. You're going to see supply side respond. But the supply of, say, like primary production, so mine sites, it takes time to respond to these price signals. Where you probably see more immediate kind of supply responses is more scrap. So can you get real prime scrap into the market quickly? And copper is a good example where we're seeing elements of that, but certainly, gold, that will be something that the market will be looking for. But this market for precious metals, particularly gold, it's not so fundamentally driven by supply and demand as much as it is by macro and financial forces. Like, keep in mind that, sorry, go on.
I was going to take you to copper, because the curiosity of copper, which has always been an industrial metal and always bought and sold on the supply and demand side, that almost seems to be taking on some of the characteristics of a precious metal now. Can you explain that to me?
Yeah, look, and it's not just copper. I think everyone tries to look at copper and link it to kind of the long-term view that we are in this super cycle because there's not enough copper for the next 10 years if the energy transition is going to happen. But if you look at what has happened with pricing, it's copper, it's zinc, it's aluminium, even nickel, but I would say nickel has surged for different reasons. But we've seen this across the base metal complex. So base metals are enjoying some of this currency debasement trade that this is being coined as, where we've seen a shift towards hard assets as people question the value of holding the US dollar. So I think that has certainly been a factor here. And I think that's a factor that's going to persist, that these kind of macro forces are going to be stronger than any fundamental supply demand view. What's helping copper even more so is we're seeing that the supply demand fundamentals, it has shifted over the last 6 months into what was expected to be a surplus this year is now expected to be another shortage. And this is really being driven by a lot of mine supply disruptions that we saw in the second half of last year. So this market for copper fundamentally is supporting pricing, but it has certainly got a massive tailwind now from this currency debasement trade, which has taken precious and base metals high.
And of course, the copper is driven by the electrification of the world. So electric vehicles, wind farms, data centres, all of these demand enormous amounts of copper. So it really is that demand side that is driving not just the mines to continue, but also even in Australia, you've got actually sort of, if you like, the processing mills, going flat out at the moment. So they've got to take advantage of these opportunities. Because I remember times when copper mines are being closed, processing mills are being closed, all this type of thing is part of that cycle over the long term.
Yeah, look, for sure. Like, I think something that we're certainly seeing is that if you bake in these higher copper prices and even the higher gold prices, because keep in mind that copper and gold, there are plenty of deposits where they occur side by side, that actually has improved the economics of a lot of sites that you would consider marginal maybe a year, 2 years ago. But getting that supply online is going to be the real focus, is can we bring that forward? Can we accelerate it? Can we take advantage of these prices? So I certainly think in the long run that picture is improved. But with copper as well, keep in mind that when you have these high prices, two things happen. One is you start seeing some substitution into aluminium. So that's certainly a risk factor to consider. But two, you're going to bring in the copper scrap into this market because that's the first thing that can tend to cyclically respond. So I think those are probably the things to watch for that will take the edge of pricing. But these macro forces that are pushing this entire metals complex higher, it is very difficult right now to stand in the way because at the end of the day, it's top-down policy from the US that is fundamentally driving this.
Okay, there's one other thing that the US policy affects, and that's energy prices and oil in particular. Now that it's got Venezuela under some sort of control, there's now the threats to Iran. I just wonder where oil prices go longer term. I noticed they popped up this week as Donald Trump was threatening his armada on Iran. But then the question about whether supply side, as he wants to drive down energy prices, and he was even this week boasting about the fuel prices in America right now.
Yeah, look, so some of it doesn't add up completely because if you're going to sort out a situation in the Middle East and do it with potentially a military strike, you're naturally going to lift the geopolitical premium that is baked into oil prices. And that's what we're seeing. It's been around that $70 a barrel for oil. And in terms of wanting that price lower, we're going to need to see more supply enter the market. And this oversupply that has been long predicted in this market over the last 12 months, it has to be realized. Now, two things to say on that. One, we still haven't seen clear evidence of this oversupply yet, despite the predictions. Because if we look at global oil stockpiles, yes, it's above the 5-year average, but a lot of that has actually come through from floating storage. So this is oil held at sea. But if you look at land-based inventories, it still is below the 5-year average. So, if we look at that floating aspect, the reason why it's being discounted is a lot of that is sanctioned Russian barrels. So no one's really looking at that and saying this is true oversupply. They just worry that that supply may not touch the market. So that's problem one. But problem two is the range of outcomes now possible in the Middle East, particularly if there's an attack, and Iran's retaliation is what the market's worried about. Of course, the Strait of Hormuz is the one everyone's talking about. That's a key waterway which controls about 15 to 20% of global supply. That's the one that has really captured the market attention and why oil is at 70. But if you want to talk about medium-term oil prices and long-term oil prices, that sits firmly in the control of OPEC Plus and what they want to do with price levels. Because they control the spare supply, they will keep adding, in our view, come April, because prices are high and global surpluses haven't been realized. And that is what's going to eventually take that price down, in our view, to about $60 a barrel. That's the level we think OPEC Plus is comfortable with. All of this near-term high prices, it's very much geopolitically driven and Middle East driven. But in the long run, it has to be a call on what does OPEC Plus want the price to be.
I'll tell you what, Vivek Dar, Commonwealth Bank's head of mining research, commodities research. Always great to chat to you from Singapore. Many thanks for your time.
Thank you.
Coming up after the break for investors, the geopolitical risks are set to continue this year, especially as we've heard with Donald Trump heading to mid-term elections. But if our inflation is repeated in the US or Europe, then watch the stock market like a hawk. That's coming up next. It is great to have your company here on Business Weekend. Well, Australia, with its higher inflation and possible higher interest rates, could be a canary in the coal mine for global investors. Because if our inflation is repeated in other parts of the world, global stock markets could have sharp reversals. Well, Edward Boyd this week caught up with Ben Powell, who is the Chief Investment Strategist for the Asia Pacific for BlackRock Investment Institute.
It's super interesting, and I think Australia is something of a bellwether maybe for something that we're going to see more around the world over the next 3 to 6 months, which is the uncomfortable fact that inflation is still a bit too high. So that's true most obviously perhaps here in Australia. That's changed the conversation quite quickly from cuts to are we going to hike or not? So we'll find out soon. And I think we're going to see that kind of conversation flow around the world over the next, let's say, 3 to 6 months. Again, because of the simple but important reason that inflation has not come down as quickly or as far as we would all prefer, and that's something that central banks are going to have to continue to worry about and deal with.
So could Australia be a bit of a canary in the coal mine for places like Europe or the United States?
Absolutely. So perhaps, as always, we're guided by Australia and what's going on here in the lucky country.
We're very important.
But in this regard, I mean, absolutely. So we have a globally perhaps positive surprise in terms of growth. Things are clipping along okay, even with all of the very dramatic news flow that's, by the way, likely to continue. So even with all of the brouhaha, growth has surprised by proving more resilient. That combined with an inflation outlook which is still problematic to the high side, yes, I think Australia could be kind of ahead of the game in a way where the conversation already here has evolved into, do we need to do some hiking? Can we kind of hang out and see what happens over the next 3 or 6 months, given the extreme uncertainty around many issues? That's going to be the conversation increasingly, I think, is should we worry about inflation and do something about it by hiking, or just try and relax and wait for more data and information and clarity to come through in the quarters ahead.
Yeah, it'll be interesting to see what the Reserve Bank does next week. But when you look at America, their economy's growing a little bit over 4%. Australia's about 2%. You know, how's the US managing to grow that rapidly compared to us here? Is it productivity? Are they more productive? Or?
Not yet. So there's a bit of that, but it's in reality for now, it's the AI capex super boom. And so, to your point, this is raising very interesting questions about the future. You know, will we all be using AI as individuals, as companies, as even governments? Probably. Will that drive productivity? I think the answer to that is likely to be yes. But now, the way it's driving growth is just the money. So estimates are something like 5 to 8 trillion US dollars with a T by the end of this decade. So the money being poured into this opportunity, I guess, is so huge that it's already a relevant contributor to growth. So the productivity, there's a bit of it, but that's probably a story for the future. The story now is a good old-fashioned capex boom, picks and shovels, and the beneficiaries being of sufficient scale that's a relevant driver even at the aggregate level of the entire economy.
Yeah, you've got a report out showing some big calls for the year. AI obviously still has a long way to go then?
We think so. So, it feels like we've been talking about AI for a couple of years, and should we move on to the next thing? No. I mean, again, it's just an unbelievable moment in human history where we're going to make intelligence kind of more readily available. It's hard to exaggerate what a big deal that is. As market strategists, we've got to take the fun out of it and think, what does that mean for the portfolio kind of today? We do think AI is going to be a dominant theme through 2026. Importantly, we need to be a little bit nuanced. So it isn't just enough to be bullish AI. We are bullish AI. You want to be nuanced within that. Think about the technology stocks. Think about other geographies that can give you exposure. Even commodities. Copper's been on an absolute tear over the last several months. I think largely because people are working through the implications for the electricity demand to kind of feed the silicon thinking machine is going to be very, very huge. We're going to need loads of copper. So AI, we're bullish, but we need to be a little bit clever within kind of the details as to exactly how we express that within a portfolio.
Yeah, copper companies, I mean, BHP, for example, shares are trading over $50, which is a pretty high level for them. But gold, precious metals really have been booming for the past couple of years, and it looks like gold price is just going to keep going higher as well.
Yeah, so inflation's still a problem, and gold's got a 6,000-year track record of buying roughly the same amount of bread today as it did 10 years ago. So the inflation hedges, I think, are still an important part of the portfolio because inflation continues to be a little bit of a problem. Furthermore, we're seeing still very, very large deficits by at least the historic standards all over the Western world. They've got lots of debts. The US federal debt is at high levels by historical standards, and that's growing because both parties, by the way, seem to be keen to do more and more kind of big deficits. There's no political appetite to kind of resolve that, quite the opposite. So again, you'd probably want to worry about that a little bit from an investment perspective, and gold is a good expression of kind of concern, helping you sleep at night, hedging against that inflation and maybe excess debt risk, which is still out there.
Just talking America as well, the currency, the US dollar's almost at its lowest level in roughly 4 years. It's really dropped away. Is this something investors need to be cautious about, or...?
I think it's fine. So it happens, right? Occasionally the dollar's stronger, occasionally it's weaker. I don't think it's symptomatic of anything too sinister. America is still where the future gets invented. So since the Manhattan Project at the end of the Second World War, they've had the good ideas, they have the scale and the financial kind of markets to turn their dreams into reality. So America is still kind of awesome, I think. That's still true. But it can also be true that there are good opportunities outside of America. So 2025, we had some combination of both of those. We had markets as far afield as Korea, Japan, even Europe, perhaps, to some people's surprise, did pretty well. So I think we could see more of that looking forward. America's still exceptional in many regards, and very interesting opportunities overseas in so-called international markets. I think that is quite likely to continue through 2026.
You mentioned geopolitics at the start. I mean, what are you expecting for this year? Is it just going to be as crazy as previous years? And we've obviously got President Trump often threatens tariffs and they turn into hollow threats.
So I think he's going to continue to be, President Trump is going to continue to be energetic in his approach to policy. What's very interesting is now we're seeing the absolute blending between economic and foreign policy. So tariff tools are absolutely front and centre, maybe the opening gambit in a negotiation transcending every facet of the relationship with countries, including their very near neighbour in Canada, through to India, through to everyone, even historic allies. So yes, I think that's going to continue. I think the president is finding them effective and even enjoyable. So I'd expect we're going to see more drama around that. And then our job as market participants is to think, to your point, is he really going to go there, or does he actually care about market performance and so forth, at least to some degree? And
do you see any other mega forces potentially affecting the markets over this calendar year?
We do. So AI is the dominant theme, and that's still kind of front and centre. But beyond that, related, very importantly related, you have the energy transition. So if you think about the AI thinking machine, it comes as a package. You can't have the silicon brain without the energy kind of underlying ecosystem and infrastructure. So they're two sides of the same coin to some degree. Thirdly, we touched on it here, the geopolitical drama and the rewiring of the global kind of norms that we've all got used to since the end of the Second World War, that is over. We are moving into a radically new paradigm where America has moved, I think, from being the guarantor to actually the disruptor. And I think it's hard to exaggerate what a big change that is. And the consequences of that are going to continue to ripple through for 26 and beyond, actually. That's a big deal.
Great to chat to you, Ben Powell, Chief Investment Strategist, APAC at the BlackRock Investment Institute.
Thank you.
Thanks for your time.
Coming up, the anti-money laundering agency Austrac already this year has shown its teeth with an investigation into the global money transfer business Air Wallex. But if you think it's only about big business, think again. Now small business is in its sights. Thanks for being with us here on Business Weekend. In the past few years, Austrac has become one of the most feared corporate regulators. The Anti-Money Laundering and Counter-Terrorism Financing Agency has scored some big scalps. Among them, the biggest, a $1.3 billion penalty against Westpac, but also $700 million for the Commonwealth Bank and $450 million against Crown Resorts. Well, already this year, Austrac has ordered an audit of the global money transfer business Air Wallex. It apparently stopped the proposed $8 billion stock market float in its tracks. Now, you might think this is all about big business, but no. Late this week, Austrac put out fresh kits for small business ahead of new reporting rules that start from July this year. Daniel Mossop is Austrac's National Manager for Policy, Rules and Guidance, and he joins me now. Daniel, many thanks for your time. I want to just start because Austrac is feared by many large companies of Australia. That reputation is a pretty good one if you come calling because of the seriousness of the nature of the business that you're in.
Yeah, thanks, Ross, and great to be with you. I think there is a reputation that Austrac has for being feared, but it's probably something that we don't entirely deserve because I think certainly the regulation relationship that we like to have with the businesses that we regulate is one of partnership, and that is the vast majority of businesses that we deal with. And this week we've launched some pretty world-leading products to help those businesses comply. And that's really where we want to focus our energy, is on getting those businesses up to scratch and complying and helping us with the Australian mission of fighting money laundering and terrorism financing.
OK, because the reality is that the big scalps, they attract the headlines, obviously. But the truth is that a lot of the money laundering that's taking place in Australia is happening in the small to medium-sized business category, because that's where, if you like, criminals can find ways to launder the money effectively and potentially to move that money offshore.
Yeah, that's right. I mean, laundering money is often just trying to catch money launderers is often described like squeezing water. It will always sort of find a way through that dirty money. And when you start to get the big businesses doing what they need to do and really searching out that money laundering, the displacement effect just moves the criminals on to the next cab on the rank, and they start through smaller businesses, medium-sized businesses. Their imperative to launder that money is absolute, and they will target any business that they think they can help them do that.
But the important aspect of this is the new laws that will come in from July 1 are going to look at areas, and we're seeing some of them on the screen: jewellers, conveyancers, accountants, lawyers. These quite often, of course, are the conduits to all forms of business, and so they also need to be the ones who are helping you and the nation do a better job in basically trying to prevent money laundering.
Yeah, for many years we've talked about these gatekeeper professions as ones that regulation would really benefit both them to protect their businesses from being exploited for money laundering, but also have a pivotal role to play in being that front line and engaging with the public as the sort of gatekeepers to the financial system and having a real front row seat to the laundering activity that's taking place. So certainly at the international level, that's been recognised for many, many years, and the international standards call on all countries to make sure that those professions and businesses are regulated. Australia is coming a little bit late to that game, but I think the benefit of that is that we get to learn from everybody else's mistakes. We've had a lot of input from countries that have already introduced these types of laws. And one of the lessons we heard really loud and clear was that the difficulty of translating those international standards and laws into practical action that particularly smaller businesses can do in their day-to-day life is a real challenge. And that's why we've stepped in with these program starter kits, which really walk people through how they want to build their AML-CTF program, teach them how to identify the risks they should be looking for, and then how to mitigate those risks and report through to Austrac to contribute to the financial intelligence that we provide to law enforcement agencies and the national intelligence community.
Sensational. It really is. It's a great story, great initiative as well. Of course, we've always tried to really, where we can, help AusTrack out in this information, and hopefully some of those businesses learn a bit more. Daniel Mossop from AusTrack, many thanks for your time today.
Thanks, Ross.
Now, to finish up, this might come as a bit of a surprise. Despite near-record stock market valuations, surveys show that financial distress amongst ASX-listed companies has surged almost 50% since 2021. Now, the cause is persistently high interest rates, tightening profit margins and rising debts in many of those organisations. The global professional services firm Alvarez & Marsal analysed 1,400 companies on the Australian stock market and found almost half are either currently distressed or at risk of distress. Edward Boyd spoke to Glenn Konevsky, who is the Managing Director at Alvarez & Marsal Corporate Restructuring, earlier this week.
We've done an analysis of over 1,400 ASX-listed companies, and we've actually looked back since the pandemic, since FY21, right through to the end of last year. And what we've actually found is that out of those 1,400 companies, the proportion that are experiencing financial distress is actually up 50%. And what that means is that we currently have a situation whereby almost 1 in 2 companies out of that sample are actually in distress or near-term risk of financial distress. And interest rates are certainly a part of the equation. Margin compression is certainly a part of the equation. We're seeing a lot of pressure on revenue, whether that's competition or whether that's cost of living and consumers not wanting to put their hands in their pockets. And on the other side, you've got those supply chain costs. They continue to rise. And actually what we've seen over that same period is a 30% compression in your profit margins right across the board.
And when you say in distress, just explain to viewers how you're getting to that word. What are the categories you want to see?
So when we talk about distress at Alvarez & Marsal, we have a global methodology that we use, and it essentially examines almost 24 KPIs, looking at, on the one side, what we call a performance score, so understanding the trading of those businesses, understanding the operations, looking at their profitability. And on the other side, we look at the balance sheet to develop a resilience score, which is really around understanding the level of debt they're carrying, the reserves. It's trying to determine how much capacity there is in those businesses to be able to withstand unforeseen shocks.
Yeah, and are there any sectors in your analysis that jump out at you as being the most under pressure at the moment?
There definitely are. There's obviously a range of sectors represented in that 1,400 sample, but the main ones that are probably overrepresented in terms of risk distress are technology. You've got healthcare, and we've seen some very well publicised challenges across private hospitals, across other care providers, private health insurers. The NDIS is a feature in terms of that sector. We see consumer and retail discretionary spending in particular across that consumer industry, industrials and mining, and we've got energy and utilities. And of course, in each one, there's winners and losers. If you take mining, for example, gold miners at the moment are having a fantastic run compared to coal miners that are on the other side of that spectrum.
So if you're the chief executive or the board of a distressed company, I mean, what can you actually do to get the business back on track?
Well, the good news is that there is an abundance of capital, whether that's institutional capital or private capital. There's certainly a lot of dry powder there. And for CEOs, for management teams that are aligned with their boards, that are able to take credible plans to their boards and execute on those plans, well, they're able to tap into that funding that is available. And if they're doing well, either continue that growth momentum, or if they need to transform or improve their performance, then they've got access to that capital for that reason too.
Yeah, are businesses trying to set themselves up now to become more resilient in this economic environment that we're in?
Well, I think we're certainly going to see a challenged environment. There's a cloudy outlook for the next 6 to 12 months, but I think those ones that are aligned, those ones that are action-oriented, that are able to be decisive, that understand risk but also tolerate some risk, I think they're actually well positioned to take advantage of this cycle and the capital that's available.
And when you look at the distress levels in Australia, I mean, how does our market compare to some of the other big regions around the world?
We're definitely a little bit higher. I think in particular, the focus that we have across our market on things like resources, I think we are looking at higher levels of distress than perhaps in other parts of the globe.
And what sort of distressed companies are you actually working with at the moment? What sort of sectors are you dealing with?
We're seeing a lot in that consumer space. We're seeing health is a challenging space, and mining right across the board, and both informal and informal advisory sort of mandates.
And I also know you're acting as an administrator right now for MA Security. Can you give us any updates on how that's going?
I probably can't go too specific, Ed, but certainly we're looking to report to creditors sort of early to mid-February, so we're right in the middle of our investigations.
But are they a good example of just one business in Australia that's under pressure at the moment, and could there be many more like them out there in our market?
Well, like I said, I think we are going to see increased rates of insolvency in particular over the next 6 to 12 months. If I go back to our analysis, what we've seen over the last 6 months is certainly a record number of listed companies going into formal processes, and that's probably coming off the back of already heightened activity, if not record activity, over the past 12 and 24 months, going back kind of since the pandemic.
And these companies that are feeling the pinch right now, if there are potentially 2 or even 3 interest rate rises from the Reserve Bank, I mean, what's that going to do? Could that just push a lot of businesses over the edge?
It's certainly a challenging environment. I'd love to have a crystal ball, and I think next week there's certainly an increase that is on the cards and is being priced in by the analysts, but we don't know what's going to happen beyond that. I just saw actually in your green room the Fed held rates steady. It's just impossible given the global nature of where we operate. It's very, very hard to say what's going to happen.
Glenn Konevsky, Managing Director at Alvarez & Marsal Corporate Restructuring. Great to talk to you.
Thanks, Ed.
And that's it for the program this Sunday. Up next, all the latest news right here on Sky News. Business Weekend returns next Sunday, but of course you can keep up to date with all the latest business news with our daily program Business Now, 4:30 p.m. Eastern Time, and via our website, skynews.com.au. Thanks for your company today. I'm Ross Greenwood. We'll see you next week.